in the coming months, and from Asia in particular, Swiss or trees?
Asian markets have been pretty volatile over the last 6 months or so, and we anticipate that that volatility will remain for much of 2016. There are headwinds that are triggering outflows from emerging markets and Asia as well. The strengthening US dollar and rising interest rates, the low oil price are triggering a degree of nervousness and risk aversion that is impacting the Asian markets. However, when you look at the fundamentals underlying the markets, Asia still looks relatively attractive. Growth is slowing, but there is still good growth. Fundamentals are intact, balance sheets are in good shape, and valuations are looking increasingly attractive, and that is creating opportunities for us and our portfolios.
China is in the eye of a storm. Will internal consumptions, lower oil price and depreciation of the currency support the growth enough to counterbalance the weak investments?
China's been front and centre of investor concerns when it comes to Asia, and rightly so. Growth is slowing, the currency has been devaluing, and that has caused some concern. I think much of this slowdown, however, has been by design. It's been engineered by the Chinese government, who are intent on moving China away from the previous investment-led, export-driven economic growth model to a model that is much more based on services, on consumption, and ultimately will be much more sustainable. So long term, that will be positive for China, and we are supporters of that policy. But in the short term, it is causing disruptions and market concerns. But equally, it's creating opportunities from an investment perspective, with opportunities in some of these new emerging services sectors, environmental sector, the travel services, domestic consumption stories. So notwithstanding the overall slowing growth picture, it is creating investment opportunities.
Many Asian countries are facing political headwinds, Malaysia among them. Do you think they will continue to condition the local currencies of these countries?
Political headwinds have certainly had quite dramatic impacts on certain markets in Asia. I think most apparent has been Malaysia, where a corruption scandal involving the Prime Minister of that country has certainly weighed on investor sentiment towards the Malaysian market and impacted the currency. So it's been an important issue to grapple with, but I would say the bulk of the pressure on currencies in Asia has had much more to do with events outside of Asia and around the strengthening US dollar than it has to do with domestic political issues within Asia. So it is that that's driving the weakness. We are conscious of the foreign exchange and currency risk, and we try and address that in our portfolios through looking at individual stocks and companies and making sure that those companies are managing this currency risk correctly and prudently.
Valuations for many Asian countries are compelling, even if return on equity is really low. Should we expect an expansion for multiples anytime soon? And which areas do you prefer?
We think valuations in Asia are already looking very attractive, certainly relative to their own history. They're trading below their long-term averages, whether that's on a price-to-earnings multiple or a price-to-book multiple. Asia is also trading at a discount to other markets and world indices. So today, Asia already looks attractive. That is providing opportunities, and in our portfolios we have been acting on that and adding to our stocks and to new stocks at more attractive valuations. It's difficult to predict when exactly we might see some multiple expansion, but for the time being we're focused on the fundamentals and are enjoying being able to buy stocks and companies at cheaper prices.
In the past weeks, it became out of fashion to talk about Fed tightening, but it would have no sense to think that the Fed will stop completely rate hikes. Do you think this could fuel further outflows from Asia, and if so, from equity, from bonds, or both?
The interest rate hike by the US Federal Reserve in December triggered some volatility in Asia, but nothing like as much as we saw back in 2013 when the Federal Reserve first said it would think about unwinding quantitative easing. In fact, overall through the fourth quarter of 2015, Asian markets actually rallied slightly after a weaker prior quarter. And through 2016, as and when we see further rate increases, we expect the Asian markets to be able to withstand those rate increases. The macroeconomic fundamentals in Asia are much less vulnerable than they were back in 2013 when we saw those dramatic market sell-offs in India and Southeast Asia. Today, current account surpluses and balances are in much better shape. Foreign exchange reserves are very healthy, and overall the macroeconomic picture, as I say, looks much more resilient, and so we don't anticipate dramatic swings in flows, although certainly as the US Federal Reserve continues to normalise its policy, that will create some volatility.